Princeton Securities Group joining us live now from the New York Stock Exchange. Good morning, Ben.
Good morning, Allison.
It looks like it's going to be a rough morning. Why is that?
It does. Well, we start with a continuation of the sell-off that started in the U.S. market, that started by a former Fed chairman making comments for a necessary correction in the equity market. That changed the whole focus on the marketplace. Then you add to that the Fed FOMC minutes that took a more hawkish turn, which has a direct relationship on currencies. That's what's the follow-through in the foreign markets. The race to devalue a currency has ended. The question is now who will manage the ascent of those currencies better than most. So you have a sell-off coming in those terms. It didn't help that you had a Russian miner make a comment about the sanctions affecting them and moving to another safe currency, the Hong Kong dollar. That took the foreign markets, the DAX, the German index, and the French index to its knees on that commentary. Coming in, as you mentioned, the jobless numbers, the unemployment claims are still a very good trend. What the market was spooked by the employment cost number that came in at 0.7 of a percentage point, basically 100% higher than was anticipated by the market. That tells you that the Fed is going to have address the issue of wage inflation and people going to work, which means you cannot expect interest rates to stay low for a considerable amount of time.
So we got some good news yesterday on GDP, Ben. 4% for the second quarter. It seems to be just a distant memory at this point with so much else going on. Is there any focus on the positive?
Well, the GDP is a positive in the sense that it shows the U.S. economy is, in fact, getting back to full speed. But the problem, again, when we talk about in the investing market, you can't have a 30-year bond yield below 4% when GDP is at 4%. That tells you there's inflationary pressure in the marketplace and rates have to rise. No matter how the Fed's trying to manipulate it, the natural markets may, in fact, take over as the Fed continues to taper their impact on the marketplace. So it is a positive. I mean, what we're talking about is negatives in the marketplace because we're trying to price prosperity. So the fact of the matter is rising interest rates actually are a good thing for equities. It's an indication of a healthy market and a healthy economy, and that's a reason why you should not be in bonds, because as interest rates rise, the value of your bond that you bought goes down. So that's another reason why eventually the money will find its way into the stock market.
Okay, Ben Willis, thanks so much for your time this morning.